Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 9, the problems that are group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so problem 9-46B. It says accounting for several current and long-term liabilities. Following are pertinent facts about events during the current year at Snow King Snowboards. Right, so 5 of them. For each item, indicate the account and the related amount to be reported as a current liability on Snow King's December 31st balance sheet. Okay. As I read the word current liability, remember, current liabilities are considered between now and the next 12 months, right? That's what's considered current, right? So if you have a mortgage, which is like 30 years, you have to break out the current portion. The current portion is, what you owe during the first 12 months. Something like accounts payable, which is only 30 days, that falls within that time frame, so that's a current liability. If the note is 30, 60, 90 days, obviously that falls within that year period. And if the note is, say, a 2-year note, well, then 1 year of that 2-year note is the current portion of that note. Right? So it says here, A, December sales totaled $371,000 and Snow King collected sales tax of 7%. The sales tax will be sent to the state of Montana early in January. So we have 371,000 in sales at 7%. That gives us $25,970. That's how much tax is owed, and that's for December sales. So that's 1 month, so that's it. Will end up as a sales tax payable. You should already know this, and then that amount, right? That's something you should already know from chapters 1, 2, and 3. All right, Snow King owes $90,000 on a long-term note payable, right? $90,000 on a long-term note payable. At December 31st, 6% interest for the year plus $25,000 of principals are payable within 1 year. Okay, so the current portion of would be the, let me write it down here. So the would be the current portion of the long-term, and I'm abbreviating long-term, notes payable, right, is going to be the $25,000 because that is the principal during that year, and we have to take into consideration that there's 6% interest. Okay, so 90,000 times 6% is $5,400. Right? So you're going to have, you're going to have your interest. Get my pen here. You're going to get your interest payable is going to be $5,400. Okay, that's what's going to show up on your current portion. All right, current liability section. All right, C says on August 31st, Snow King signed a 6-month 7% note payable to purchase a machine costing $126,000. The note requires payment of principal and interest at maturity. Right? So the note payable I'm abbreviating, is going to be $126,000 because it's a 6-month note. And you're going to have interest payable because you're going to also calculate interest and pay on it. So $126,000 at 7% is the amount of the interest, which ends up being $2,940. So our interest payable is going to show up as $2,940 in the current liability section. Okay, D, it says sales of $1,276,000 were covered by a Snow King product warranty. At January 1st, estimated warranty payable was $9,200. During the year, Snow King recorded warranty expense of $31,400 and paid warranty claims of $33,800. Right? So we're talking about our estimated warranty, and I'm abbreviating, payable here. Okay, so we want to know how much is going to be in that estimated warranty payable account, right? Estimated warranty payable. So it says here the balance in that account was $9,200 on January 1st for $9,200. During the year, recorded a warranty expense of $31,400. Okay, now it says warranty expense. Go back and watch the theory videos about estimating warranty, all right, and what that journal entry would be, all right. When you're, I'm not going to go over how to calculate estimated warranty, but when you end up making that estimation, you're going to debit warranty expense, and you're going to credit estimated warranty payable, all right. So we're going to credit the warranty payable for $31,400 because we recorded the warranty expense of $31,400, right? Just be aware that you know, you have to include that. You have to be able to think through the entire concept. You can't just look and say, oh, warranty expense is not a liability, so I don't include it, right? You have to think through all of the concept and apply what is necessary. This is not memorization, all right? It's understanding and application. Okay, so then it also had warranty claims of $33,800, right? So that's going to be a debit of $33,800. And when you add them all up, you end up with a credit balance of $6,800. So our estimated warranty payable on the current liability is going to show $6,800. Okay, before I go any further, again, and I keep on hammering at this and pounding it away. I mean, that's what this slide was all about. Okay, if you don't understand the underlying concepts, you have to go back and, you know, pick them up, because you can sit here and watch me do this, okay, but if I'm not, you know, you're not going to find this situation all of the time, right? You're going to find little changes like this in the way the information is presented, and that's the way it gets presented in the real world, okay? It doesn't necessarily come in the neat little package that you want to see it in because you read it in a book, right? It comes at you, and if you have to be able to place it all inside that concept that you understand and be able to figure it all out. And this is a prime example of that, right? Where if you just looked at warranty expense and didn't think through this, you're getting the problem wrong. Okay? All right. So let's see here. And then E, Snow King received cash of $13,500 in advance on the rent for the rent on a building. This rent will be earned evenly over 6 months. Prepaid rent, right? Prepaid rent is for $13,500. Okay, so if, just like Accounts receivable and accounts payable are two sides of the same coin. If you have prepaid rent and you're giving to another company, you know, that company is showing it as unearned rent revenue. Okay, and the rent will be earned evenly over 6 months. So let's draw a timeline here. So this here is 10/31, 11, I guess 30. This is December. This is January, February, 1, 2, 3, 4, 5, and this is April 31st, I think it is. Let's see here. Let me look at my calendar. Nope. April 30th, March 31, February 28, January 31, December 31. All right. So the problem here says, the receiving cash is prepaid rent for $13,500. Okay. In advance on the building. This rent is earned evenly over 6 months. So this is 1 month, 2, 3, 4, 5, 6. Okay. Now this is October 31st, and it's saying we're looking at the balance sheet at the end of December 31st. Okay, so on October 31st, our unearned rent revenue is going to show the full $13,500. Okay, that's on October 31st, but that's not what we're looking for. We're looking for the amount that's going to be in that account at the end of December. Okay, so if it's at the end of December, how much is left? How much is going to be left in that account on December 31st? We would have already earned the revenue for the month of October, and the month of November, and we would have earned the revenue for the month of December. So we have $13,500, and there's going to be 4 months left that we haven't earned out of the 6. So 13,500 times 4, and then divide by 6 gives us $9,000. And so on the current portion of the current liability portion of our liability section is going to show unearned rent revenue for $9,000. Okay, so that's it for this problem. And again, if you didn't understand the underlying concepts, like you don't get prepaid rent and how it relates to unearned rent revenue, go back and watch earlier videos. And if you didn't understand estimated warranty expense, go back and watch those. You're missing something from previous chapters. And if you still don't get it, then feel free to telephone and speak with an instructor. Okay, I'll see you in the next video.